Welcome to this explainer. I'm really thrilled you're here today because we're taking on a genuinely fascinating mission. Our goal? To totally strip away the deafening noise of gross revenue and find out the true, unvarnished efficiency of Tesla's manufacturing floor. If you follow the EV space, you already know exactly how loud the conversation gets. But today, we're not looking at flashy headlines. We're looking at the math. To set the tone for our investigation today, let's start with a bit of a contrarian reality check. Forget the hype and the headlines. Tesla's stock price doesn't tell you how efficient their factories actually are. To find the truth, we're stripping away the noise and using vertical analysis to expose their raw manufacturing costs. You know, it's so easy to get caught up in the daily ticker symbol, right? But to truly understand a manufacturing giant, we literally have to bypass the stock market entirely and step right onto the factory floor. Okay, let's dive into this. Section 1, Smoke and Mirrors, the Hype of Gross Revenue. When a company is moving millions of units, the top-line revenue numbers become absolutely massive. And while massive top-line numbers look amazing on press releases, they can actually act as a smokescreen in the EV sector. They completely blind us to the smaller, structural details of the business. Just look at the contrast here. On one side, you've got this intense industry obsession with top-line growth, right? The delivery numbers, the sheer volume of cars pushed out the door to meet quarterly expectations. That's the hype. But on the exact opposite side, we have the hidden reality of deep-seated manufacturing inefficiencies. Ramping up volume at a breakneck pace can actually lead to rushed processes, higher scrap rates on the floor, excessive overtime pay, and logistical bottlenecks that just quietly eat away at margins. So you can sell a record number of vehicles and generate record-breaking revenue, all while your actual per-vehicle manufacturing efficiency is bleeding out behind the scenes. So how do we fix this? Section 2, the tool. What is vertical analysis? How do we actually pierce through that top-line smokescreen? Well, we pull out a magnifying glass to conduct a strict reality check. Vertical analysis is basically the ultimate tool to see past clever accounting. It works by benchmarking every single line item on an income statement directly against total sales. Because, let's be honest, looking at billions of dollars in a vacuum is almost impossible to conceptualize. Instead, we view the financials as a percentage of a single dollar earned. It completely normalizes the data. It wipes away the distraction of massive scale, ignores the volume of cars sold, and leaves us with pure, comparable ratios that tell us what's really going on. I want you to literally imagine a single dollar of revenue. Just hold it in your mind. Using vertical analysis, we're going to track exactly where every single cent of this dollar goes, how many pennies stay in the company's pocket as profit, and how many pennies leak out onto the factory floor to cover the sheer cost of building the car. This $1 is going to be the key to unlocking the true story of Tesla's efficiency. Now, what's really interesting is Section 3, the core engine, dissecting cost of goods sold. This brings us to the absolute heart of the matter. Cost of goods sold, or COGS, is where we absolutely have to spend our time if we want to understand a manufacturing company. By isolating the COGS ratio, we bypass the delivery hype entirely. Breaking down the COGS percentage reveals exactly, down to the literal decimal, how much it costs to physically build a vehicle today. We're looking at the raw, unedited efficiency of the manufacturing floor. Think about what this actually means. This isn't the marketing budget, this isn't administrative overhead, and it's definitely not software R&D. This is the literal physical cost of stamping heavy metal, molding interior plastics, wiring harnesses, and assembling dense battery packs into a drivable car. When you strip away everything else, the COGS ratio tells you if the core engine of the business is healthy or if it's struggling. And this brilliantly illustrates the intense battle currently raging on Tesla's production floor. There are basically three distinct forces locked in a constant tug-of-war. First, we have the massive impact of the 4680 battery cell production ramp. Scaling up a completely new battery architecture is incredibly capital-intensive. It requires entirely new machinery, complex manufacturing lines, and early on, you just have to deal with lower production yields. All of that heavily inflates the total manufacturing cost ratio. Second, fighting against those costs, we actually do see hardware costs shrinking. This is where Tesla's engineering really shines. Through innovations like massive gigacastings that replace dozens of individual parts with a single piece of metal, they are successfully engineering the physical vehicle to be cheaper to produce. But then we hit the third force, and it's honestly the most alarming. Raw material inflation is threatening to eat the production floor alive. The brilliant engineering gains achieved by the hardware teams are being almost immediately offset by the skyrocketing costs of essential EV commodities, like lithium, nickel, and cobalt. It really doesn't matter how efficiently you can cast a car frame if the chemical ingredients for your battery packs double in price. The efficiency gains aren't a literal street fight with raw material inflation. Which leads us to a highly provocative question we have to ask ourselves as we track this data. Take a moment to really consider this. Is massive scale actually driving sustainable profitability for Tesla, or is the inefficiency of the floor simply being hidden by massive revenue volume? When you sell enough cars, you can temporarily hide a shrinking margin. But vertical analysis, it doesn't let you hide forever. Let's move ahead and see how this builds in Section 4, the future outlook, the margin squeeze reality. So we've spent our time looking at the present battle on the factory floor, but vertical analysis also acts as a really vital predictive tool. Because we've successfully isolated the true manufacturing costs from the top-line revenue, we can look past the current delivery hype and foresee a brutal reality approaching. The data from our vertical analysis points directly toward a significant margin squeeze expected by 2026. If raw material inflation continues to outpace the shrinking hardware costs, and if the efficiency gains of the 4680 battery ramp stall out, the physical cost to build each vehicle will inevitably eat further and further into that single dollar of revenue we visualized earlier. So why does this matter to you right now? Because stock valuations and company health aren't based on just today's deliveries. They're based on future cash flows. A margin squeeze means less profit per car, which eventually means less capital for future R&D, supercharger network expansion, and new factory lines. And the crazy part is, we can see this trend forming right now, deep in the COGS ratio, long before the gross revenue numbers will ever officially reflect it. So I want to leave you with this lingering thought to chew on today. Based on the raw, normalized data of their actual production costs heading into the realities of 2026, is Tesla truly still the king of manufacturing margins? The top-line numbers will always shout the loudest, but as we've seen today, the quiet math of the factory floor always tells the truest story. Thank you so much for joining me for this explainer. I hope this profoundly changes the way you look at the next big earnings report.